Tickmill, which is called Building a Naked Trading Strategy. Welcome. My name is Rowan, and before we start, I would like to learn a little bit about your trading background so we can set up our webinar better. Please share in chat all of your questions that appear during the session, and if possible, mark short comments about your own experience. Which are your favorite trading strategies, currency pairs, or other trading instruments, so we can adjust the session accordingly. As for me, I'm trading since 2008 and have recently focused on so-called naked trading, also known as indicator-free trading. This method includes specific number of tools, which allows us to take a winning strategy without using most of known indicators. This webinar is a final part of a bigger series, Naked Trading Principles, that was held every Wednesday. So if you like it, I hope you join us again in a week. For the upcoming session, here you see the agenda. First, we will review major tools of indicator-free trading, such as historical levels, dynamic levels, pivot points, Elliott wave theory, and Fibonacci instruments such as retracements and extensions. Then I will explain in short how to master a naked trading plan, or a trading plan without technical indicators. And finally, we will turn to live charts, so you can see how we can adapt the tools that we would be describing first in a live environment. So once again, you are most welcome to share your thoughts and your ideas, probably some questions, in the chat section. I'll be following it throughout the webinar and we'll be standing ready to help you. In case some of you have also got some experience in individual trading, you probably know that any winning trading strategy won't be working sustainably without a proven and trustful partner. This is important to be indicated not in trading skills, but in trading conditions as well. So please have a look on features offered by Tickmill. If your broker doesn't provide you with such essentials as competitive spreads, segregated funds, and lack of free quotes, you'd better think of it once again. Going through disclaimer. As usual, I start the introduction with a famous quote for Walter Peters, who you probably know from other forex trading courses, who says focusing on indicators may be one of the primary reasons that some forex traders do not make money. Indicators can be confusing and helpful and just plain wrong. So the primary idea behind the indicator-free trading strategy is that it helps you to concentrate on the current price dynamics, unlike indicators, which just include the past performance of price action. As you probably know, past performance doesn't guarantee you the current performance. So why giving it so much attention? To start with, as a first step, we choose historical levels. Going to definition, historical levels are long-term static levels, which are most commonly reviewed on weekly or daily charts. The trick behind them is that they are not visible in intraday charts like 15 minutes or hourly time frame, because they are usually posted like several years ago. It may be 7 years, 12 years, but still you need to find out how to remember them during everyday trading. A good indication of historical level is provided by currency pair Australian dollar to United States dollar. If you see the lower red line on the chart, is a static level of 0.2260, which was first indicated as a useful static level back in 2004. Then it was helpful once again in 2006, so 9 years ago. It helped the price to stop in late 2008. It worked as a resistance. And if you follow this currency instrument lately, you will probably know that 0.7260 has become another vital static support point for the current selling pressure of Australian dollar. So the price has tested 0.7260 support 2 times already, but still it manages to hold above this level. So if you didn't have this historical level in your mind, you probably miss a very important static support level. The next point is reviewing current static and dynamic levels. So static level is a broader view on historical levels, but it is just one of possible implications. Static levels can also be based on previous minimum and maximum points on your intraday charts, and they are pivot points as well. We will return to them a bit later. As for dynamic levels, they are projections of trending lines that are connecting certain extreme levels. I want you to have a better image of this theoretical concept, so we are turning back to charts. Here you can see an hourly chart of United States dollar to Swiss franc. And this chart shows you both static and dynamic level. As for static level, you can see resistance put at 0.9690. It was set in the beginning of the month. The static resistance was confirmed during the next point of testing. I will mark it in blue color now. So, and then it works once again in the current given situation. So let's see how the price develops. As you can see, in a few days, we have marked this 0.9690 static resistance. It was tested a few times in the following days, but finally it has retraced back to, guess what, a dynamic level. This dynamic level is provided by an ascending dynamic trend line, which starts from the 15th date of the month and connects two minimum levels at point 0.9360 and also 0.94 exactly. The confirmation goes through two more points when the dynamic support was tested for 2 times, and it became actual. So this chart gives you a good indication how static and dynamic levels can be used. In the first case, static level was used as a good entry point for the trade when the price has tested static resistance. you used it to enter range trade. So you could enter selling point with and put the stop loss right above the testing level, or to have a stop loss above the previous maximum point. And the target point is also clear. It's the moment when the price tests the dynamic level. So just thanks to such basic things as static and dynamic level, you would be able to provide a full trade from the start till the closing decision. Moving further, pivot points. Pivot points were described in details during previous session on last Wednesday, the 12th. You can either go to a YouTube channel of Tickmill Broker to find the live recording, or ask your personal manager in the account section to share it with you. So you can get a better understanding of what actually the concept of pivot point means. As for now, pivot point is a tool used in Forex market to determine actual static levels, both support and resistance. Unlike historical static levels that have one fixed value of pivot point's value is regularly updated based on selected time frame. The reason why it is regularly updated stays behind the idea of pivot points, which are calculated from the previous numbers of high levels. As you can see on the given chart, the pivot point is selected in red color. Pivot resistance levels are marked in blue and support levels in green. So usually pivot points work as a good static support and resistance levels. They can either help you to make a breakout trade, as it has been provided this opportunity at level 1.11 exactly, or it can give you a good entry point for range trading when the price touches next resistance and then goes below. It gives you the idea of right entry point. As you may notice, all three types of given examples are basically different kinds of static and dynamic levels, and they present a specific part of naked trading strategy. In case you have some questions regarding setting any of these lines, you can ask me in chat. In case there are no exact questions, we are moving forward, as indicator-free trading involves few more useful tools, which are not primarily based on different kind of levels. And one of such examples is wave theory that was formulated before by Ralph Nelson Elliott. Here you can see a standard Elliott wave cycle, which says that all the movements on the markets can be detached in impulse and correction phases, and the traders are able to see a specific correlations between impulse moves and correction moves. So before market makes it actual step, you can already be aware what it would be. So as it has been shown in the chart, we see a certain upside move on United States dollar to Japanese yen currency chart, starting from January 2015 and going through the middle of March. The price has developed a 5 elements move, which is a traditional indication of impulse move. So this point has helped you to understand that the upcoming move is going to be an impulsive one. So once the current top has been reached, you have been waiting for the correction move, and after that you would be right expecting the next impulse move. So if you are trading dollar to yen by yourself, you probably see that this historical outlook is correct because the depicted top is set at 122 exactly, whereas the current value of yen is lower than this depicted bottom. And finally, the trading strategy won't be complete without Fibonacci instruments. The most popular type of Fibonacci implementation is retracement levels. These retracements are ratios which are produced from mathematical sequence known as the Fibonacci sequence. These ratios reflect potential reversal levels. First of all, you need to follow 38.2% and 61.8% ratios, which are most common reversal levels. The other retracement level of 23.6% is an usual reversal point for strong and impulsive trends. Going back to the chart example, you may notice that this current example of euro to dollar gives you an indication that 61.8 Fibonacci retracement level has given you the right area of reversal point. So during the end of May, it has been tested several times. It has provided you with a fake spike below this level, but the price has quickly retraced back above the key level and could give you the right entry point for a buying trade. Another way of using Fibonacci numbers is extension. Extensions basically mean a reversed pattern of retracements. So if retracements follow the ratios inside the trading range, Fibonacci extension provides you the same ratios, such as 38.2% and 161.8% beyond the given range. So once again, comparing with retracement level, it usually gives you the correct reversal point, whereas extension level is being usually used as a good. Here you see another intraday chart of euro to dollar, and you can see that as a basic distance has been used the trading range of the first bearish wave. Then the beginning of Fibonacci extension has been set to the following top level, and the best levels to watch were 138.2 and 161.8, which finally has given you the right indication of a trend reversal. By this point, you know all the definite elements of naked trading plan, and it's high time for you to make up a complete picture of it. So let's go through it once again quickly. As the first step, you set historical levels on big time frames. Then you choose intraday timeframes and try reviewing current static and dynamic levels. As the following point, you adjust pivot points. After these 3 steps are being completed, your chart is presumably complete with all actual static and dynamic levels that you need to follow throughout your trading strategy. Then you try to find similarities in the waves that are being produced on the certain currency pair using Elliott wave theory. Finally, you include Fibonacci instruments such as extensions and retracements. Afterwards, you combine all of them and see the results. That's it. I hope that you have got a clear understanding of the indicator-free trading plan, and all of their elements are understandable for you. In order to have a better picture of it, we are switching now to a live trading platform, so we can analyze the current currency instruments and their current price action using the trading plan that we have completed in the first part of the session. Once again, if you have got any specific questions, please post them to me. In case you have a special interest in any certain trading instrument, you can also share it with me. But my intention is that we start with euro to dollar currency pair because it's the best known option for currency traders. Please confirm to me that you have switched to live trading charts correctly. If everything is fine, you should be able to watch weekly chart of euro to dollar. So before we start with the trading session, let's see for the questions. Yusuf asks which pivot point instrument is okay. There are Fibo daily and other types. So Yusuf, if I get your question correct, you have probably noted that there are different ways of calculating the pivot points. The difference of them between them are in formulas. For example, standard pivot point calculation includes high, low, and closing levels. Fibonacci pivots use the same formula, but they also include these Fibonacci ratios, which were described later, such as 38.2% and 61.8%. If you compare both of these types of pivot points, you would see a little difference in them. My suggestion is that Fibonacci pivots are closer to each other because they use these ratios, which makes the numbers closer. So if you're more of intraday trader and you're following your trades inside one trading day, I suggest you using Fibonacci pivot points. in case you are more of a mid-term trader, so you hold your trading positions for 3, 5, 10 days in a row without closing them, the better option would be standard pivot points. And for the time frame selected, there is a technical opportunity to calculate pivot points on hourly, 4-hour, daily, and weekly charts. But the most popular levels are daily pivot points. So please consider it once you choose a time frame. Let's move back to live trading. So here you see a weekly chart of euro to United States dollar. And as it has been written in our trading plan, we start with setting up historical levels. To complete all of them, we use a horizontal line, and we will watch what are the potential levels around our current price of 1.1038. The first obvious state level is set at the level 1.1638. It's obvious thanks to the low of November 2005, when this minimum level was rather obvious. And if you see a historical performance of euro to dollar, you will likely see that the same value is confirmed also in November of year 1997. So in case we see an upside move from the current levels, we need to remember 1.1638 level as a probable resistance. From the other side, I invite you to pay attention to 1.0761, which works as a static support level. It has been tested in March and April of the current year, and then later in the beginning of July, this static level didn't allow to get the price below it. So basically on the weekly chart, it seems that euro dollar is trading in a range between 1.0761 to 1.1638. And going for the origins of this level, it has been noticed in September 2003 and has been confirmed in perspective in April 1998 and July 1997. So basically both levels are having a historical background of 18 years. So in case you are trading euro-dollar currency instrument, I definitely recommend you to remember both of these levels. We can also look at the 1.1092 static level, which was the current top level for March in year 2003. But unfortunately, we are not able to see another confirmation of this level. If we move the instrument here, well, we can see that this level has stopped the pair for during the decline in January 2015. But from historical perspective, there is not so much confirmation regarding this level. So maybe we can use it. The exact value is 1.1083 as some additional to watch. It's especially interesting for us because it's really close to the current trading level of the currency pair. Of course, you can see more historical levels, such as 1.23, 30, 1.18, 76, or 1.2042. But it seems that throughout the last year, the price is trading range of 1.07, 1.16. So probably you need to review your long-term historical levels once one of these borders is being successfully tested. Now let's see what the price offers for us on a different time frames. We are going to look for static and dynamic levels. We are descending from weekly chart to daily chart to 8-hour chart. And probably we need to spend some more time in the 8-hour chart because it provides us with the opportunity to give to provide some dynamic levels. So I invite you to follow the trading range, the time range between the beginning of October 2014 and the middle of December 2014. It's obvious that during the decline, euro-dollar has provided some consolidation move in this trading, and we can use it to post some trending lines and see how they work. So I connect top levels of October 21st and October 29th. I also connect the top of September 16th with October 15th. But as you can see, this current value is not really perfect because of a big spike. And as you probably know, spike is not a good trading example. So we move to October 21st as well and connect these levels. It's always okay to compare the performance of multiple lines and then leave those who have some confirmed performance. On the downside, we connect the extreme levels of 3rd of October with 7th of November. And as you can see, this price is interesting because it has been tested 2 more times before it has been broken. So maybe we need to adjust it with a different color right away from here. Now we zoom out to the current trading levels and see how it works. So no wonder that this descending trend line, which has been confirmed 2 times before trading, has proved to be very valuable for the current trading as well. So it's marked with a red color now, and it has worked as a dynamic resistance level in 18th of June. And it has also technically worked just last Wednesday on August 12th as a dynamic resistance level at the point of 1.1212. So this is definitely a great dynamic resistance, remember, until the euro-dollar trades below 1.12 because this dynamic level has got a proven performance. As for the other lines, the other one just confirms a more precise signal from a more precise signal from the descending trend line from the bottoms. Except for it, we can leave the other lines. So the two upper lines could have become actual in case euro-dollar fixes beyond the current brown line. Let's move closer and see what are the actual static levels for the chart. Definitely, I suggest you remembering a neckline at 1.1390, which has worked as static resistance multiple times during May 2015. Another area of static resistance is set at the current trading level of 1.102030 during March of 2015. And also the recent low of 1.0820 is confirmed with the low which has been produced in May, in the end of May of the current month. So from the perspective of 8-hour time frame, the price is being descending after unsuccessful test of dynamic resistance set from 3rd of October 2014, and it currently tests the static support level of 1.1027 from March 2015. In case it breaks below it, it is likely that we follow to the next support line of 1.0817. In case it retraces back, it is likely that it tests again 1.1180, which is the current value of the dynamic resistance that has been chosen before. Hour and 2-hour charts give us basically the same picture. So we are able to move to intraday charts. Now we are on an hourly time frame, and before we know probable dynamic levels on hourly time frame, let's get back to pivot points. So I will calculate it quickly for the current day, and then we will adjust it on our chart. I will use standard pivot points for euro dollar calculated from the daily chart. So the pivot point for today is 1.1045. And this is a basic indication of current market trend. A general belief is that a price below the pivot point gives you a bigger understanding of what is the current market sentiment is. So in current situation, it's more towards bearish decline, but in reality, you can see that the price spans a really narrow range. So it has been both below and above the pivot point. So there is no clear indication of the sentiment at the moment. No wonder, because we are trading now ahead of a bigger event from Fed, which will have a bigger fundamental impact on the pair. But still, let's complete the pivot points. Support levels are 0.998, 69, and 22. I hope I remember all of them from the beginning. So 1.0998, almost. 1.0969, success. And finally 1.0922. I invite you to follow the same steps during my presentation. So you do all of them on your own charts, so you have got a better understanding of how it works. And you would also be able to compare the levels that we adjust in live mode at the moment with the following trading later today or later in the week to see how it actually affects your trading. So given the last third line of support of 1.0922, needless to say that it should be a very important static level, as it combines with the previous static lows of 7th of July, 24th of July, 31st of July, and also 10th of August. If you're just following euro-dollar, please try to remember all these static lines and follow the performance of the price action around these values. So Lukman, you're asking about different type of pivot points. Choosing between standard, Fibonacci, Camarilla, there are also Woody's, and the best option is to follow the most popular ones. So the most popular are standard types of pivot points. They are most widespread and usually more accurate. If you compare standard and Fibonacci pivot points, you will see little difference in them. And in fact, pivot point itself and several support and resistance levels will be the same between standard and Fibonacci. If you're interested in alternative types of pivot points, I would also suggest you to follow Woody's. Here is the correct name. But once again, you compare the exact levels on daily chart between standard and Woody's, you would see just little deviation between the numbers, like 5 to 7 pips. And the main idea of pivot point is giving you a potential area. So probably you won't see the very technically perfect test of the exact point, but you can just compare different types of pivot points. As for me, your suggestion is right. Is interesting in creating all-in-one pivot point, but in reality, you will see that the lines from different pivot points systems or calculations will be very close to each other. So in case you create such indicator, you are most welcome to share it with us, and we will see it performance together. As for me, I'm currently using a standard way of calculating pivots. Given the resistance levels, it suggests us for euro-dollar the values of 1.1074, 1.1121, and 1.1150. Let's put it on the chart. So here we go, 1.1074, 1.1122, and 1.1150. So as you can currently see, the price move more towards the downside. Let's see some further dynamic levels and see if they give us a better suggestion for the current trading. Well, so this is interesting. If you connect the maximum levels from June 29th and July 10th, you can see that this dynamic level has been confirmed later in July 2 times. It didn't allow the price to go higher on 27th of July and 31st of July. And recently it works as a dynamic support level for this currency instrument. So during our webinar, the price has technically tested 1.1016, which is the exact projection level of this trading line, and didn't allow to go further below. So in case you're following Euro USD, I suggest you put in same dynamic line, and once you see a retracement, you can open the trades in opposite direction, or otherwise, once you see this line is broken, it will be a very good indication for you to open a selling trade. So once the price goes below 1.1016, this level will start working as a resistance level again. Finally, let's move for the intraday chart. Probably it's too low. I guess this time frame would be nice. So it's a 30 minutes time frame. And let's connect the lower bands of recent upside move, like this. So as you can see, it connects the lowest levels of starting from beginning of August, from the level of 1.0847. It goes through some minor levels of 1.08 74 and 1.0922, which is the support level based on pivot points. And currently it provides you a dynamic resistance around area 1.1110. The other dynamic resistance is provided to you if you connect to recent highs from the last week, and it gives you another dynamic resistance in the area of 1.1140. Another line to watch connects you with the current price action. So the price is really indecisive in the current area, unfortunately. But basically, if we are able to stay below 1.1040, the correct projection value of the lower blue line, we would be able to test 1.1016, which has been stopped on hourly chart before, if you remember, and afterwards continue a decline below 1.1016, like this. Another ways of decline are set on these dynamic levels. If you want to see how it works with Fibonacci, we put retracements. We connect the lows and highs of the recent decline. So you are able to see that dynamic lines correspond to 61.8%. So this area of 111.40 in the intraday view is very important for euro dollar because first it's a dynamic projection of descending trend line, and second it's the 61% retracement ratio according to Fibonacci theory. Questions, anyone? So in case no clear questions for now, let's wrap up our indicator-free analysis, starting from weekly chart again. In recent year, we are trading below 0.0761 and 1.1638 trading range, and the current trading is mostly associated with 1.1083, which works as a static resistance level at the moment. 8-hour time frame provides with important dynamic resistance, which starts in October of last year and has recently stopped the upside move for euro dollar, and it continues to be a valid dynamic resistance point around the area of 1.1170. Current static point of 1.1027 provides additional support for euro dollar, and decline below it will open the road to 1.0817. On hourly time frame, we have put current pivot points for today. As we see, the most important levels are pivot point itself, with the current value right below it. And the most important support level for intraday trading is set at 1.0922. It's been also confirmed with static lows starting from 7th of July. The other important point of hourly chart is a descending trend line, which is marked in blue and starts in the end of June 2015. Currently, it gives an immediate dynamic support level for euro dollar. Once we see that the price go below this level, we are able to see its decline to the next level of 10922. Alternative scenario is that this current support holds and euro dollar retraces back to the upside. If that is correct, the first levels to watch are 1.1110 and especially 1.1140, which is both projection of dynamic line from 12th of August and also 61.8 Fibonacci retracement ratio for the recent decline. So that's it for euro dollar. I hope it gives you a good understanding how you can use a naked trading strategy that you have been able with this time. I give you the general plan of mastering your indicator-free trading plan, so you can follow it by yourself. I hope that you agree with me that all of the tools that have been described today are really obvious and are really simple to find and use by yourself. So you can try and test it not only on euro dollar, but on other currency instruments as well. All you need is to be very attentive. So, look, do you ask about the current trading for euro dollar at FIBO level 61.8? For today, I remind you that later today you will have a Federal Reserve event, and it usually coincides with very volatile movements. Probably we will see that the price will go 150 pips in any of directions. So I would not suggest to put tight stops before it, because usually under such market conditions you can see a big spikes. That means that the price goes 50 to 70 points in one direction and then dramatically retraces back. So my idea is that you, if you're a beginner, is that you stay out of market until tomorrow, because tomorrow already market picture for euro dollar can be very different, and under general conditions, 61.8 Fibonacci level at 1.1140 is a good entry point for selling. But what would you put as a stop loss? Have you got any ideas by yourself, Lukman? So, and stop loss around level 76. Let me see. So you suggest that you put stop loss right above the dynamic resistance level that we have found out on 8-hour chart, right? So if that's your idea, that's a great indication. I see that you have understood the idea of naked trading plan. So this logic is correct, and such a trading plan is right. But you need to understand that under Federal Reserve event, there is a risk that price goes with a spike above this resistance level of 1.1176 and then quickly retraces back below it. So if you are ready to take such a risk, then you are ready to open such trade. But my general suggestion is that once you're planning intraday trades, you better stay out of market for Federal Reserve event. And this is a good time to give you some further notices. The first, the second idea has been already started for you. That spike doesn't mean a signal. If you are familiar with candlestick charts, you probably see that sometimes there are big spikes, which demonstrates that the price quickly tests certain level and then goes in an opposite direction very quickly. So when you are making a decision about the trades, you need to avoid spikes because they are usually a fake signals and not a confirmation. A better confirmation, and that's a first rule, is a combination of different tools. So as we have seen on the intraday chart of euro dollar, the dynamic line combines with the 61.8 Fibonacci retracement level. And it's clear that you see two indicator-free tools that meet in the same level. So this is a good indication that this level is worthy to follow. And my final thought coincides to risk management. High rate of winning trades doesn't mean a profit. My idea is that you always need to understand that each and every of your winning trade is bigger by the volume and by the number of pips in comparison to losing trade. For example, if you have 70% of winning trades and just 30% of losing trades, and at the same time you have an average profit of 10 pips for winning trade and 80 pips for losing trade, then you probably won't fix the profit. Once you test the described tools on demo account, it's high time to check its performance live. And that's the right time when Tickmill can help you. The broker offers you a classic account where you do not have to deposit as much and where the trading conditions are nevertheless great. With Tickmill's classic account, you can enjoy trading with quite low spread that starts at 1.2 pips on Euro USD. In addition to this, there are absolutely no commissions attached to this account. This is quite an important feature for the beginners, as it lets them to focus on primarily the market without spending time on calculating the profitability due to the commissions. I believe that's it for today. To sum up, indicator-free trading strategy is a harmonical method to analyze the financial and forex market. The tools are simple to understand, as you could clearly see by today's experience, and at the same time, they give you a very precise signals. We meet next time to cover different alternative methods of naked trading. I would be happy and welcoming to see you again on the Tickmill webinars. I wish you have found this session useful, and in case you want to learn more about the trading strategy, I invite you to visit Tickmill section webinars. You can find there my profile as a market expert and see the recordings of previous webinars, which have been dedicated to specific tools of naked trading as well. And if you have got some specific questions on current market situation, please feel free to contact your personal manager in your trading in your personal account page, and ask them to share my contact details. So probably we can keep in touch directly. And for now, I wish you find this session useful and it brings you order and profitable balance to your own strategy. Thank you again and have a profitable trading ahead, guys. Bye.